Hi, welcome back. In the last session, we got a better understanding of what financial statements are, and we understood that these are the final results that we expect from our accounting system. Before we go on, I thought it would be useful to take a look at what is our roadmap. What is the journey that we need to undertake in order to finally arrive at our financial statements? This is our roadmap for the rest of the session. We're going to get started by helping you to set up what we call your buckets of accounts. These are basically, in accounting terms, known as your general ledger accounts. And the start of any accounting process begins with setting up a list or a chart of accounts. We'll then talk about how do we increase or decrease amounts within these buckets. We'll go on then to finally building a continuous accounting process or system, also known as an accounting cycle, which goes through the basic process or steps of analyzing and capturing your transactions. These are also known as journal entries, posting these transactions to your buckets, recording some other adjusting entries, and then finally preparing a list of amounts in these buckets. This is known as your trial balance. Once we have a trial balance, it is very straightforward to then create your financial statements, which is our end result. And then we'll just go through some closing entries. After the session, we will also talk about taking these financial statements and trying to analyze the health of your business and to monitor your health of your business using these financial statements. So let's get started. Alright, let's get started then with helping you to set up your what we call buckets of accounts. And what we mean by that is basically we need a way to keep track of the various items that will eventually flow through to the financial statements. If you recall from the previous session, we talked about various financial statements such as the balance sheet and the income statement. On the balance sheet, you'll notice that there were categories for assets, liabilities, and equity. And on the income statement, we had sections for revenue and expenses. Just as a refresher, assets are basically things that the company owns. So these are items that would have a future economic benefit to the company. So it's something that we have that will eventually help us to generate revenues and expenses and has a future economic benefit. Liabilities are things that the company owes. Equity is then the remaining value that's left over in the business. And that flows through from both the initial capital that's in the business as well as on an ongoing basis, the profit and loss that's earned. And that's kept track of on the income statement side. So that would be the revenues and expenses, and the difference between this is the profit or loss in the business. And again, at the end of every period, that would flow through to the equity to show what the value is. So those are basically the two statements. So on one side, we had the balance sheet, and on the other side we had the income statement. And you'll notice that we have the equation, what we call the balance sheet equation, which is that assets should equal to the liabilities and equity, and that basically means that what the company owns should balance against what it owes and what the residual value left over in the business is, and that must always balance. And part of this comes from, the equity comes from the revenues and expense side of it. So let's talk now about the various accounts. So we'll use the example of Ron. If you recall, Ron started his own small business, Ron's Designs, which was doing web design for various clients. And Ron needed a way to keep track of all of his transactions, and he knew that at the end of the day he would have to produce some financial statements. So Ron has various items that he owns that he would want to keep track of separately. So he knows that he has obviously cash in the business. There's also accounts receivable, and what those are basically sales that he made to clients, not on a cash basis, but on a credit basis, and the clients owe him money later. In some companies, they may have things called inventory. That's basically if they were to buy and sell things. In the case of Ron, it may not be so applicable, but if there was a retail business, or if he decided that he wanted to start purchasing and selling, say, software, he would need to keep track of that inventory. He also had equipment, and various equipment. We spoke initially only about his laptop, but there may be other things that he put into the business as well, such as office equipment or his telephone system, things like that, and they would be kept track of under equipment. On the liability side, he may have things called accounts payable, and these are basically amounts that he would owe to supplier for purchasing things on credit. or to vendors. Similarly, he had his debt, and that was the debt that he was owing to his mom. So debts or loans would be another liability account that he would want to keep track of. And then on the equity side, he had his initial capital that he invested in the business. But also, as we mentioned, the equity is basically the value of the company that increases or decreases both based on the initial capital as well as on an ongoing basis from the profit or loss that's recorded on the income statement, and that would increase or decrease the value of the business. And for that, we would keep track of that separately in an account called retained earnings. So retained earnings. On the income statement side, there is revenue, and we can either have just a single account for revenue or sales, or you may want to segregate those into the various segments. If you have different types of, say, products or geographical areas, you may have different sales accounts for them. For now, we'll just leave it as one sales account. And then on the expense side, these are basically items that are spent in order to earn this revenue. So where revenues are items that are earned by the business, expenses are things that are spent in order to earn that revenue. So in Ron's case, perhaps he has to pay rent, perhaps to his mom, for running his business from home. He may have hydro expenses. There could also be telephone expenses or cell phone expenses. He may also incur internet connection expenses to hook up to the internet. He may also have web hosting expenses that he pays a supplier to host the website. Perhaps he has advertising expenses in order to get new clients. And maybe over time he will decide to hire people, so he has to keep track of the salary expense that he would pay them, or even to himself. So those are the various expense items that are incurred in order to earn this revenue. So as you can see here, we have various different types of accounts, and it's useful to think of each of these accounts as a bucket. So for example, there's a bucket for cash, there's one for accounts receivable, inventory, and equipment. And the reason we think of these as buckets is it allows us then to keep track of what goes in and out of each of these buckets, so that at the end of the period we know what the amount left over in these buckets are, and then from that we can easily create our financial statements. Now, so there are various buckets here for each of these amounts. There'll be one for retained earnings, perhaps there's one for sales, and then there'll be one for each one of these expense items. Now, in some cases, you may actually want to have some smaller buckets that would flow through to the larger bucket. So for example, in the case of accounts receivable, we may want to keep track of the amounts that are receivable from each of the clients in a separate bucket, and then each of these flows through to the main bucket over here. And similarly, from an accounts payable standpoint, you may have smaller buckets that for each of the suppliers or vendors, and each one of these flows through to the main bucket over here. And also, as I mentioned, in the case of sales, you may have smaller sales buckets for each product or each geographical region, and those flow through into the main sales bucket here. And then from a presentation standpoint on the financial statements, we would just include the amounts in total on the main bucket. Now, each of these buckets, when we look at them from an accounting terminology, we call these general ledger accounts. So these are all known as general ledger accounts. I just think it's useful to think of them as buckets. And usually whenever you set up, if you're using an accounting package such as ACPAC or QuickBooks or Simply Accounting, you'll notice that the first thing it asks you to do when you set up a new company is to create these various accounts or buckets under each of these categories for assets, liabilities, equity, etc. And it does that so that it is able to keep track of what these various amounts are within the system. So initially, when you create this list is known as a chart of accounts. So that's just some accounting talk for basically these buckets. And so we call, as I mentioned, we call all of these the general ledger accounts. But these smaller buckets over here are what will be kept track of in what's called a subledger. So So, for example, in the case of accounts receivable, you may have sub-ledger accounts for each of the clients that then flow through to the general ledger account for accounts receivable, which would just be the total. And the total of all of these sub-ledger buckets should match to what the total is in this accounts receivable bucket. Similarly, on the accounts payable side, you would have a sub-ledger for all your various suppliers, keeping track of them separately, but then the totals of them should match to what's in the general ledger bucket for accounts payable. So hopefully that gives you an overview of what these various accounts are. And as I mentioned, in any accounting system, whether you create a manual accounting system, say on a spreadsheet such as Excel, or if you're using a more complex accounting package, in any case, you always have to first start off by creating what these various buckets of accounts are. If you were using a spreadsheet, it may be useful to create each one of these in a separate tab on, say, Excel or on your spreadsheet. And if you're using a more complex accounting package, the package would usually have you set these up right at the start, including what the opening balances are or opening amounts are for each of these buckets, so that on an ongoing basis, the system can then keep track of what goes in and out of each of these buckets. In the next segment, we'll talk about how to keep what we mean by increasing and decreasing amounts in each of these buckets, or what we call debits and credits, and which ones would increase and which ones would decrease these various different accounts. Thanks for watching.